So actually, one of the most surprising things that has emerged from your thesis, and this is, if I understand it correctly, I recall a conversation maybe with Grant Williams where you you described the fact that historically active mutual funds held about 5% cash on average, just to manage withdrawal redemptions and investment, and that a typical index fund like the Vanguard Total Market Fund, for example, holds about 0.1% cash,
Right.
and that the migration, so an investor sells at the margin, they sell an active mutual fund and they buy a passive index fund. There's a transfer of, that 5% that was held in cash, the vast majority of that now gets deployed into the market. And I think you made the rather astonishing claim that in theory, if everybody did that, that would result in about a 50-fold increase in market valuations. And I was just wondering if you could sort of walk us through, and I could have misinterpreted that, but maybe just walk us through the mechanics of that and how you arrived at that general, what the math of that looks like.
Sure. So the math is actually very straightforward, and it can be thought of in two separate frameworks, right? If you create conditions under which somebody values cash, they're willing to hold it as 5% of their portfolio because they need to meet redemptions, they need to position themselves to take advantage of opportunities in adverse situations without having to sell securities, right? So that cash on hand becomes valuable in a market drawdown. And you replace it with somebody who effectively views cash as a toxic phenomenon, right? I can't hold cash, right? If I hold cash, I get killed, right? Well, you're willing to pay a lot more for stuff under those conditions if cash becomes a toxic asset, right? If you walk through the simple math of it, right? And, we have some slides that we share with our investors on this sort of stuff, walking through the very simple mathematics behind it. But you can just think about it in like the simplest form. So let's just imagine a scenario in which there's $1,000 total capital invested into funds, right? And so if we start with 100% active, that means you're going to have $1,000 total. $950 is going to be equities and $50 is going to be cash, right? If you decide that you're going to replace an active manager with a passive manager, so let's take $10 from the active managers and give it to passive managers. When you do that, you're actually taking $10 of cash from the active management community. So they now have $40 in cash, $950 of equities. You're handing that $10 to the passive manager, who now has $10 in cash and $0 in equities. And the two of them want to rebalance their portfolio, right? By definition, the active managers are going to want to sell $9.50 of securities to get themselves back to 5% cash. The active manager, or the passive managers, are going to want to buy $9.99 worth of stock, right, to get themselves to 10 basis points of cash. Well, that's not a market clearing phenomenon. You can't have that. You can't have somebody paying $9.99 and somebody else receiving $9.50. And so you actually have to solve that problem iteratively to understand where that transaction will actually occur. And the astonishing fact is when you do that, you discover that on that tiny move, just taking the market from 0% passive to 1% passive, you're going to lead to a more than 1% increase in equity prices in order to solve that phenomenon. The cash can't change, right? There has to be $50 of cash at the end of it, and suddenly it has to be 4.9% of the market, right? And so when you run through this calculation, that's where you get to the 50x as you take this to its logical conclusion.
I see. So that's why you reference Mish and his assertion that there's no such thing as cash on the sidelines, that the cash needs to net.
Correct.
But the market also needs to clear. And so
Correct.
That's why you get this amplification mechanism on the price vector, because
Correct.
That's the only way that transaction can clear. Okay.
Correct.
Okay. That makes sense.
43%, I think, is the, Adam, we were talking about this earlier, 43% of equity holdings are now held in passive vehicles. How much of that move do you estimate may have already occurred, Michael?
Well, so I'm a little confused by what you mean in terms of the 50x increase.
Yes, correct.
About 2.3x, right? So, if I'm right, we've got another give or take 20x to go.
So it's an accelerating phenomenon.
It,
right?
it absolutely is. And you can think
There's
about it
dramatic
in the
convexity
extreme,
to that.
right? Just think about it in the extreme version, right? You're 99% passive. How do you get that last 1% active manager who's hodled through this whole process, right? How do you get him to sell to you? Right? You just, and he knows the minute he sells, he's out, right? He can't get back in because you'll never sell to him again, right? So what's the price at which that clears? And the answer is the market on that last component, the market goes up 10x.
And isn't that what we observe in bubble phenomena
100%.
generally, right?
Yeah,
You
no, I
see
think that's
that
right.
intensification all the way up the chain until such time as that last dollar flows in. Now, I guess the big question is, how do you determine when we get to the last dollar? Is it in fact require 100% shift to passive, or does it occur at some point before that? Are there ebbs and flows along the way? I'm sure there are.
The problem is that alongside that shift, you have an increase in volatility, right? And volatility can effectively be thought of as your speed on the highway, right? So, you're cruising along at 55 miles an hour on an uncrowded highway. Your odds of an accident are pretty low. Take it to 65, they go up. 75, they go up, right? 100 miles an hour, man, you're starting to get a little sketchy here. Just to put it in perspective, like if you think about volatility as a function of that same type of multiple, by the time you get to around 90% passive, you're traveling at 400 miles an hour on the freeway, right? Like you're going to have an accident. And so I don't actually think we're going to get there. The question is just, is the accident so bad that we don't have capital markets anymore? And I think there's a very real risk of that.
Are you able
so
to?
it's a state of criticality more than it is, anticipating exactly when that threshold is. It's sort of identifying that there is an accelerating state of criticality and that you need to be increasingly prepared for
That's exactly right. And so that's part of, people ask us from a professional standpoint, like, well, when is this going to happen? And I got to tell you, well, first of all, if I knew exactly when it was going to happen, I wouldn't tell you, right? And secondly, if I knew exactly when it would happen, and I knew, like, if I knew in either direction, I wouldn't bother putting on the positions that we have at Logico, which by and large are straddles, right? So our objective is to put on a straddle and say, we don't know which way the market's going to go. We just don't want to pay the penalty associated with that indecision, right? So we're going to use everything in our power to express that straddle in a way that we can carry it positively for our investors.
Right. And so the straddle is a function of positioning for the skew, but avoiding sort of that consistent negative drift.
Yes, that's exactly right. My complaint against the traditional long vol type product, right, is that it has some, the marketing pitch is some variant of, we promise you that yes, we're going to lose money every single year, but we promise you in over the course of 10 years, you'll be really happy, right? Well, I've been doing this closing in on 30 years now, right? And I can assure you that if I'd ever entered into a 9-year time period where I lost money 9 years in a row, I still wouldn't be doing this, right? It's not an honest expectation to turn to anyone, particularly a CIO, and say, you should incur behavior that's going to subtract 2 to 3% from your return on any given year. But boy, I assure you in that 10th year, it's going to really pay off, right? And one of the interesting phenomena for us actually has been the very positive feedback that we've gotten in the aftermath of the March events, where some people in the long vol space, reported 4,000% returns in March, right? And the vitriol that engendered amongst their client base, are like, that is absolute garbage. That's just not true, right? It was really interesting. So, the knock on long vol, I think, is deserved, right? You can't expect people to lose money on a continuous basis to protect your portfolio.
Right. And so you're trying to capture both tails, not just the left tail. And then you're also subsidizing that potential negative carry with basically a long equity overlay, right? But with specific characteristics.
Specific characteristics. So it's not long equity; it's actually long options, right? So Wayne and I talk about this on a regular basis, and it's one of these weird dynamics, right? People will reach out to us and they'll say, "Well, how do you how do you handle an environment in which the VIX is really high, right? Or the VIX is in backwardation, right? And I'm like, well, we don't actually trade VIX, right? So I could actually care less. Many of the features of the term structure that you see in the VIX are a byproduct of what's actually called a correlation convexity. A correlation coefficient is actually what it's called. I'm sorry. That highlights the dynamics that you have higher certainty about the behavior of the market in the short term, less certainty about it in the longer term, and so you have a fairly upward sloping curve in volatility that doesn't really exist in single stock space, right? It's not the same. The skew dynamics, again, that you see in terms of the indices, those are largely a byproduct of an expectation of higher correlation as you move to the tails, right? And so there's penalties associated with that we take advantage of. We think that, it's funny you talk about the tails, like we actually focus more on what I would describe as the shoulders, right? We think the shoulders are a lot cheaper. And actually, ironically, many of our competitors that are classified as long vol will sell the shoulders to finance the tails. While we would never sell volatility because that's contra thesis, we look at selling those shoulders as wrong. Right, we just think that we think that you're actually selling the cheapest part of the market.